And welcome back to Principles of Accounting 2. I am still your host, Dr. B. Happy to have you with us as we are nearing the conclusion of the fall 2023 semester. We in a classroom are in week 6. There are really only 7 weeks for this course, which means this is the second to last week. Our last lecture will be next Tuesday. So first and foremost, I want to say thank you to all of you for a wonderful semester so far. Appreciate your patience throughout the semester. I know that it was a little bumpy, but we managed to get through it. This semester, this course is brand new. It was redesigned during the summer, and so I'm looking forward to your feedback to see what your thoughts were overall. And so we'll talk a little bit more about that next week, but I just wanted to quickly say thank you for all of your hard work so far. Let's continue to work hard and finish strong. We have a couple of things for this week and a few things for next week. So for this week, we have week 6 discussion board. We also have a LinkedIn Learning Certificate. So those are your two engage and explore activities. And then you also have the chapter 24 quiz and chapter 25 quiz. And of course, you'll submit your LinkedIn Learning Certificate just like you did with the other ones, okay? If you have questions, need help with the LinkedIn Learning Certificate or anything else in the course, please feel free to reach out to me. I'll be happy to help you out. So that is where we are in the classroom. So having said that, let's go ahead and jump into our discussion on performance measurement and responsibility accounting, which is chapter 24 of our textbook. So let me swap the views and all that fun stuff, and let's get started. Okay, so this chapter, there's a couple of difficult parts that I will help to walk you through. One of those is called transfer pricing, which is where where two managers negotiate a price to transfer the work being produced. Uh, it's based off of the levels of production and the capacity of production. That's what transfer pricing is. And so we'll talk a little bit about that, and I'll help to walk you through that difficult concept. Uh, and we'll also talk about um, responsibility accounting and what all that means. So let's go ahead and jump into it. So in management, one of the things that we do is we need to understand how effective our operations are. We look at our costs, our profit being generated from the revenue, and we also look at our property, plant, and equipment investments into the business to evaluate the performance of the company. As a manager, it's so important for me to control cost as much as possible. As you know, there's a lot of cost associated with running a business. There are controllable costs and uncontrollable costs. And we're going to talk about what these are here. So, as a manager, I evaluate the performance of my company by looking at the costs, profits, and investments that I make. I look at the company overall, but I divide the company into these three areas in order to better understand the overall performance. A large company, we tend to divide the company up into units or divisions or segments or departments in order to understand at the unit level the overall performance of that unit. to understand the detail when it comes to things like profitability. An example of this, I like Macy's, the department store. Macy's is a very large organization. They have a lot of different stores scattered throughout the country and throughout the world for that matter. Macy's, the department store, within the store itself, you have a lot of different departments. That's why we call it a department store. Departments include things like the women's department, men's department, children department, jewelry department, homewares department, etc. Yeah. These departments within the store sell their respective wares. Okay. So, as a store manager of Macy's, I look at each individual department within the store and evaluate each department based off of their ability to control costs in comparison to the budgeted costs, their ability to generate a profit from their sales, and their ability to generate the sales from the use of the property, plant, and equipment. So a large company like Macy's looks at each individual department and evaluates each department based off of these three centers: cost center, profit center, investment center. It helps management to evaluate the performance of the managers for each department as well. Okay. So I mentioned that as a manager, I need to be able to control my controllable costs. There are two types of costs that a department manager faces: controllable costs and uncontrollable costs. Controllable costs are the costs that the department manager can control, just as the name implies. For example, controllable costs that a manager has control over include things like the hours worked in their department by the employee, the hourly wages of the employees working in that department, the amount of inventory the department carries, the sales prices of the inventory within the department. All these are controllable. The department manager has control over their department costs, like the hourly wages, the amount of hours worked, the inventory being carried, sales prices, etc. The department manager has the responsibility of controlling those costs. Those are what we call controllable costs. Then there's the uncontrollable costs. These are costs outside of the department manager's control. An example of this would be the department manager's own salary. The department manager cannot set their own salary. That's a cost outside of the department's control. The store manager sets the department manager's salary. Macy's. Okay. Other examples of uncontrollable costs: the amount of electricity used by the store. The department manager can't control that. Okay. The department manager cannot control the store manager's salary. The department manager cannot control rent prices or insurance. These expenses are outside of the department manager's responsibility. Okay. department manager of the jewelry department cannot control those things. Okay. So those are what we call uncontrollable costs. However, it's important to note that the department manager's performance is evaluated on their ability to control their controllable costs in comparison to the budget. You see, it's an important point to know. So why are we talking about all these controllable costs, uncontrollable costs? Because these types of costs are a part of what we call responsibility accounting. Responsibility accounting recognizes the control over costs and expenses that belong to the levels of management. The department manager is responsible for managing the department's costs that can be controlled. You'll notice this organizational chart. This organizational chart represents the different levels of management. The lowest level of management here on this chart are the department managers. Each individual department manager is responsible for controlling their department's costs. You'll notice that the department managers report, in this example, to the plant manager or to the store manager. In my Macy's example, department managers in Macy's report to the store manager. The store manager reports to the district manager. The district manager reports to the executive vice president of the region. The executive vice president of the region reports to the president of the company. The president of the company reports to the board of directors. That is the organizational chart of Macy's. Okay. In this example that you see on the screen, this is for a food processing company that has beverage, food, and service. Those three departments report to the plant manager reports to the executive vice president, and then the president, board of directors. That's how things are reported up the chain. Okay. The reason why this slide is important for you to understand the different levels of management is because in responsibility accounting, we look at what's called performance reports. These performance reports list out the actual costs that managers are responsible for and their budgeted amounts. We analyze the difference between the budgeted and actual amounts to understand the variance. Okay. The variance is how we evaluate the performance of each level of management. Taking a look at our example, the department managers at the very bottom here have controllable costs, like direct materials, direct labor, and to some degree, utilities. Okay. We compare the budget amount to the actual performance to understand the variance. We add up all the variances to understand if they're over or under the budgeted amount. Actual minus budget, actual minus budget. That gives you the difference. Yeah? So we can see in this example, the department manager is over budget by $300. That's a little concerning. Okay? It's not actually 300, it's like $300 million. Okay? So a little bit more substantial. That department manager reports to the plant manager. Okay? So for that department, you can see that their department line totals go onto the plant manager's budget. Okay? So 300 over for that department. The plant manager also has controllable costs, such as the salaries for the department managers, building rent, insurance, and then each individual department. If we add up the over under budget variance, we can see that this plant manager is over budget by $2,800 million. That's a problem. So what about the division or the region of the company? So here we have the region. This particular plant manager is a part of the Western region. Region rolls up, totals roll up to the executive vice president's budget. The executive vice president has controllable costs of plant manager salaries, depreciation, office expenses, the Western and Eastern regions. We add up all of the variance for the executive vice president's budget. And we see that this particular executive vice president is under budget by $5,900. You can see the differences from each level of management. You can also see the potential impact on those managers. Now, the department managers only over budget by a little bit. Maybe not the biggest deal, right? Right? But then there's this. You look at the division manager, the plant manager. Plant manager is 2,800 over. It could be a problem for that plant manager. That's kind of serious. It's a problem. Food department was way over. Average department was a little over. Service department was under. But remember, the department each individual manager is evaluated on their ability to control costs that they can control. So to be 2,800 over budget, it could be a problem for this manager. Who looks the best out of these three managers? It would be the executive vice president. Because the vice president budget, this person's under budget by 5,900. The executive vice president looks like a hero right here, right? That manager probably going to get fired. Department manager might be all right. You see the importance of looking at each level of management based on the level of detail. You'll notice that the lowest level of management often has the greatest level of detail when it comes to their costs. And that's, of course, because the closer that you are to the product and to the customer, the greater level of detail you can see. As it rolls up, a little less detail. As it rolls up again, a lot less detail. You see? So it's a very interesting way of reporting the levels of management and their ability to control costs. So that's responsibility accounting. Relatively straightforward. The way to think about responsibility accounting is it's the ability of each manager to be able to control their respective costs. Now, as you know, from cost accounting, when we talked about our costs earlier on in this course, it was probably like maybe the first week or the second week, we talked about direct and indirect costs. Remember? Direct costs are costs we can directly trace to the product. Indirect costs are costs that we cannot directly trace to the product. I'm sure you remember the conversation a few weeks ago, so I'll cut you a little slack, but you should remember that conversation. So let's take a look at how these direct and indirect costs are tracked to the departments. We know how they're tracked to products, but how are they tracked to departments? Direct cost or direct expense. Are costs traced directly to the department because they were incurred for that department's sole benefit. Okay, a couple of keywords here. Incurred means that those costs happened in that department for that department's sole benefit. The reason why cost happens is because we're trying to generate revenue. The revenue for the sales is the benefit. For example, hourly wages for the jewelry department at Macy's is a direct expense for the jewelry department. The reason why the wages expense exists is for the benefit of the department to generate sales from that department. The jewelry department makes sales because we have employees selling the jewelry. The wage expense of those employees is a direct expense for the department. You see, it's cause and effect. The sales are being made, that's the benefit. The incurred expense are the wages for that department. Yeah, makes sense. So that's an example of direct expenses. Then we have indirect expenses. Indirect expenses are costs that are incurred for the joint benefit of multiple departments. They cannot be traced directly to one department. An indirect expense. Here's an example of this. I'm going to use the same example, okay? Macy's jewelry department. Macy's jewelry department is a part of the store. The store has joint expenses. For example, every night, individuals clean the store. They go through and they vacuum the carpets, they wash the floors, they put away all of the stuff, they wipe down the glass, clean the fixtures, make the store look nice. Okay? That's the cleaning crew. The cleaning crew is a contract company that Macy's comes and has cleans the store. All right? They clean the whole store, not just the jewelry department. So when Macy's gets the bill for a month's worth of cleaning for the store, it's an indirect expense for the jewelry department. Here's why. Because the cleaners clean the entire store, not just the jewelry department. So the way it works is that Macy's receives the cleaning bill for the whole store. they decide the best way to allocate this total expense for cleaning is by square foot of each department. That's how we allocate the cost to each department. It's an indirect expense because it benefits the whole store, not just the jewelry department. Does that make sense? You understand indirect expense now? Good? Hopefully. All still awake? Okay. Thank you, Liz. All right. Keep going. Okay. So you heard my example of the cleaning crew coming in to clean the store, Macy's. Macy's gets the bill at the end of the month. They allocate the indirect expense based off of square footage. And that's usually how it works. Seriously, for that type of thing. Here are a couple of other examples of indirect expenses. The supervisor's salary, the store manager's salary. How do you allocate the store manager's salary? This person's responsible for managing the entire store. We have to allocate that person's salary. The way we do that is we take the entire amount of salary and divide it by the number of employees total and multiply that by each department. So we take the number of employees working in the jewelry department and we allocate the supervisor's salary based off the number of employees in each department. The number of employees for each department is the activity base for allocating the supervisor's salary. Another example is rent and utilities. Rent's for the whole store. The utilities are for the whole store, not just the jewelry department. So how do we allocate rent and utilities? We do it based off of the square foot of each department. So how do you do that, you might ask? You take the total square foot of the store and you figure out the square foot of each department. Okay, you measure it out. Once you have the square foot for each department, we take the total cost and we divide by the total square footage of the store multiplied by the square foot of the department. Okay, well, that's one way to do it. You can also express it as a percentage. 100% square foot divided by the percentage of the jewelry department. Find the percentage, square foot percentage of the jewelry department, multiply that by the total cost. That gives you the cost of the rent and utilities for the jewelry department. Another example of indirect expenses is advertising. Macy's advertises for the whole store, not just the jewelry department. Okay. So the advertising expense is allocated using percentage of total sales. And insurance, another indirect expense. We allocate this based off of the value of the insured assets. How much is all your inventory worth for that department? That's how we allocate it. Okay. The formula for the allocation is we take the total cost that needs to be allocated, multiply that by the percentage of the allocation base used. Always to find that percentage, I'll walk through an example or two with you. Okay. So we talked about the indirect cost allocation. There's a separate cost allocation I need you to understand. We call this service departments. We have operational departments, those are the departments that do the selling, right? Like the jewelry department, clothing department, the whatever department. They sell inventory. We call those operational departments. Okay. Then we have what's called service departments. Service departments are supportive departments. They support the operations. Okay. Example would be the accounting office, payroll, human resources, purchasing, maintenance, general office. These are all service departments that support the operations departments. You see? We need to allocate the costs of these support departments or service departments to the operational departments. Okay? So here's how we do it. We find a common allocation base. For example, the general office department, it's based off the number of employees or sales in each department. For personnel and payroll, it's based off the number of employees for each department. For purchases, it's based off the dollars or number of purchase orders. And then maintenance, it's done by square footage. Just like my earlier example of the cleaning crew contracted out to clean the jewelry department, square foot. So I'm going to walk through an example of our retail store for the cleaning services. So here we go. So here's Macy's. Okay. 800 a month is probably more like 800 a day, but you know, that's besides the point. It's probably more. But keep our example easy, Macy's. We have our store, okay? We contracted with a company to come clean the store. They charge us 800 a month. Great. So we need to allocate the cost of the cleaning service to each department. How do we do that? We do it by selecting the allocation base. In our example, the allocation base is based off of the square footage of each department. So here's some information. The total size of the store is 4,000 square feet. Small Macy's. Okay. We have 3 departments. We have jewelry, repair, and clothing. We know what the square footage is of each department. The jewelry department square foot is 2,400. 600 square foot for a repair department and 1,000 square feet for a clothing department, giving us the total square footage of 4,000. We need to find the percentage of the allocation base. The way we do that is we take the square foot of the department divided by the total square feet. Okay, for jewelry, 2,400 divided by 4,000 is 60%. 50% for repair, 25% for clothing. Equal 100%. How do we know the percentage of the square feet for each department? We take the total cost of the cleaning service, $800, and we multiply that by the percentage of the square foot for each department. So 60% times 800 is $480 allocated to the jewelry department for the cleaning service. $120 for repair department and $200 for clothing department. the total will be 100. That's how we allocate an indirect expense to each department. Any questions on this? Hopefully this makes perfect sense. Good? Okay. All right, let's keep rolling. So now that we know how to allocate the indirect expenses and the service department expenses, we need to prepare a departmental income statement. Each department has their own income statement. For example, the jewelry department at Macy's has its own income statement. As you know, the income statement shows the sales that the department made, and all of the expenses allocated to that department. At the end, we get the net income for the department. So let me show you how it looks. Okay, here's the formula we use to determine the department income. We take department sales minus the department direct expenses that we can directly trace to the department, like the hourly wages of the employees in the department, the inventory in the department, etc. Minus the indirect expenses, like the allocated cleaning expense, the jewelry department. And then minus the allocated service department expenses, like, for example, rent, total rent divided by the square foot of the department, allocate, or percentage. Multiply the percentage on the square foot times the total rent to allocate that to the department. Sales minus direct expenses minus allocated indirect expenses minus allocated service department expenses equals department net income. That's the formula. In order to understand this formula, we need to build out the income statement. Okay, we do that in 3 steps. Okay, the first step is like this. We find the sales, the direct expenses, and the indirect expenses for each department. So the operating departments and the sales minus cost of goods sold for each department. We have the salaries for each department based off the hourly wages. And we have depreciation for equipment used in each department. Those are our direct expenses. We see those listed out for the operating side. We also listed out the indirect expenses for the whole company, rent and advertising in this example. Total expenses $208,000. Okay, so step 2 is we have to allocate these indirect expenses to the operating departments. We do that based off of the allocation basis for the activities, right? So here we have rent, indirect expense. We have to allocate it to the 2 departments, hiking and camping, and purchasing. Sorry, purchasing is our service department. So we allocate based off of the square footage for rent. Makes perfect sense. Find the square feet of each department. Divide that by the total square foot for each department to get the percentage square foot for each department. For example, purchasing square foot is 1,800 out of 9,000, that's 20%. Parking is 2,700 out of 9,000, that's 30%. 4,500 out of 9,000 is 50. I take the total amount of rent, 12,000, multiplied by the percentage, to allocate the cost of rent to each department. Yeah, makes sense. I do follow the same process with advertising, which is another indirect expense. For advertising, the allocation base is based off of the amount of sales dollars from each operating department. You'll notice that I did not allocate advertising expense to the purchasing department. The reason for that is because the purchasing department does not generate sales. We cannot allocate an expense like advertising that's a result of sales to a service department. The way that works is it's based off of the percentage of sales. Marketing department sales were 136,200 out of a total 227,000 in sales. That's 60%, which means the other department had 40%. We allocate the cost. 4,000 times 60% is 2,400. 4,000 times 40%, 1,600. So now I've allocated my indirect expenses. The third step in the process is to allocate the service departments to the operating departments. There's two operating departments, hiking and camping. There's one service department, and that's purchases. Okay? The purchase expenses is 19,400. Why 19,400? That's because we added in some rent to the purchasing department, plus all of the purchases based off of the number of purchase orders from each department. Okay. So, here we go. 19,400 total expenses for the purchasing department. We allocate it based off of the number of purchase orders. The total number of purchase orders for the company was $1,200 for the year. Okay. Hiking department had 840, camping had 360. 840 divided by 1,200 is 70%. 360 divided by 1,200 is 30%. We get the percentage, multiply that by the total amount, 19,400. We get the allocated cost, 13,580 and 5,820 respectively, equal the total 19,400. Those are the three steps that we follow to formulate the income statement for each department. You'll notice here toward the bottom, we've allocated the direct and indirect expenses and the service department expenses. So to put it all together, it looks like this. The two departments. Sales minus cost of goods sold equals gross profit minus the direct expenses that we allocated, minus the allocated indirect expenses, rent, advertising, minus the purchase department expenses, equals an income of 24,000. So that's the process. 3 steps. That's how we build out the income statements for the departments. You'll notice that in this example, the hiking department was positive 24,000. Camping was negative 5,000 income. Total for the company, 19,000. As a department manager of the camping department, I might be a little worried. Okay, because my controllable expenses are probably a little high. Okay, so you know how to allocate the direct and indirect expenses in the service department to the operating departments. We also need to be able to allocate overhead. Department contributions to overhead is sales minus cost of goods sold and minus direct expenses. Sales minus cost of goods sold equals gross profit. Gross profit minus the direct expenses equals the department contribution to overhead. Remember, the word contribution, similar to contribution margin. Contribution margin. Something we talked about back in Principles of Accounting 1. We briefly talked about it a few weeks ago. Contribution margin. Okay. We talked about controllable costs. We talked about profit based off of this income statement. Now we need to talk about the investment centers. Investment centers is the utilization of operating assets in each department. How well the company is using their assets in order to generate revenue. That's what the investment center looks at. How well is each department manager doing? Investment center managers, department managers are responsible for revenues and costs and the investment of operating assets to help to generate revenue. We have an example. This example looks at a company that produces both LCD televisions and phones. We'll say it's Samsung. Keep it easy, okay? Samsung. Samsung produces both LCD televisions and phones. So we have some data for Samsung. We have income of televisions at 750,000 and for the phones, 770,000. The average assets of televisions is 2.5 million and for the phones it's 1.85 million. So we, in order to understand each department's performance, need to run out what we call a return on investment calculation. Return on investment calculation, we take income divided by average assets. Okay. So income for the LCD TVs is 750 divided by 2.5 million average assets is 30%. The phones is 20%. These are the return on investment formulas. So now that I know the return on investment for each department, I also need to know residual income from each department. Residual income is the additional income that is generated that's more than the target income. Okay? Which helps to increase the company's value. So The way we find this is by taking income minus the target income to equal the residual income. How do we find target income? We take the average assets and multiply that by the target percentage of average assets. In this example, it's 8%. So average assets times 8%. For the LCDs, it's 200,000. For the phones, it's 148,000. So income minus target income equals residual value. Residual income. Okay, now that we know residual income, we know return on assets. We then need to further analyze the performance of the company and the departments to understand how well they're using their investments. One such formula is called the return on investment. Return on investment is calculated by taking the profit margin times the investment turnover. Complex. These are actually two separate formulas that we're multiplying together. You break it down by saying return on investment is income divided by sales times sales divided by average assets. Now, as you recall from your math courses, we have what we call common numerator denominator, right? So when I multiply these together, I'm actually looking at income divided by average assets. In order to understand return on investment. Okay. Now that we know how to do that, one of the last things we do to analyze the performance of the department or the company is to use what we call the balanced scorecard approach to the investment system. A balanced scorecard is a system of performance measures that helps us to consider financial and non-financial information to evaluate the performance of the company or the department. We look at four primary areas in a balanced scorecard: customers, internal processes, research and development, and financial information. Those are the four areas we look at. You'll notice it combines financial and non-financial information together. We look at customers to understand what do the customers think of the company or the department. Look at things like satisfaction ratings, number of new customers, on-time deliveries, etc. Customer data. We also look at internal processes, which is operations that are most critical to the customer. This would include things like looking at the defect rates, product costs, labor hours, warranty claims, etc. These are all part of internal processes. It helps the company to look at what they're doing right and to improve what they're not doing right. When it comes to research and development, we look at how the company can improve. To do that, we look at things like employee satisfaction rates, employee turnover, for new products, amount spent on research. And we also look at the financial data. Look at income, sales growth, profit margin, investment turnover, etc. All of these together represent what we call key performance indicators. Key performance indicators tell us how well the company is doing as a benchmark for their budgeted and actual performance, or their goals for their actual performance. Way of measuring the company's growth. Okay, so everything we just talked about is responsibility accounting. Now, I want to, in that same light, I want to talk about this concept called transfer pricing. This part, a little bit more complex to understand, so I'm going to walk through a little bit slowly so you'll grasp the understanding of what is transfer pricing. I want you to think about two different managers within the same company that are trying to maximize the output of their manufacturing. Divisions within a company sometimes do business with each other. We call this transfer pricing. It's where the price to record the transfer of goods and services from one division to another within the same company is called transfer pricing. Transfer prices are used in cost, profit, and investment centers that we just learned about. In thinking about our earlier example of Samsung making LCD televisions and phones, and understanding the capability or capacity of their ability to manufacture televisions and phones, we consider what's known as transfer price. Transfer price is the price to record the transfers of goods across divisions within the same company. On the left, I have the manager that makes LCD televisions. On the right, I have the manager that makes the phones. Okay. The two negotiate with each other to transfer manufacturing capability and the additional inventory from one division to another. Okay. So the LCD manager calls up the phone manager and says, hey, I have reached capacity. I need to transfer a bunch of additional inventory to your division so I can keep making more. In order to do this, the two managers negotiate what we call a low transfer price. The low transfer price is the variable cost of manufacturing that product. The variable cost per unit of an LCD TV is $30. The cost cannot go below $30. The market price for the LCD TVs is $80 to buy. So the negotiating range is going to be between the low transfer price and a high transfer price, which is also known as the market price. Okay. Typically, in this type of situation, the managers usually agree on the lowest possible price, which is the variable cost per unit. In some cases, like this example, they're agreeing on the highest transfer price. There's no excess capacity. When there's no additional capacity, LCD manager cannot accept a transfer price of less than a market price. When there is excess capacity to produce, the transfer price will be somewhere between $50 and $80, which is the cost plus for transferring the products to the other division. And of course, then there's a lot of excess capacity, which is the lowest transfer price, which is $30. So that's how the basics of transfer pricing works. Does it get more complex than this? Yes, absolutely it does. But I wanted you to understand the very basics of transfer pricing works. So that's transfer pricing. Any questions on transfer pricing? We're doing okay. Okay. All right. Okay. So we talked a lot about the costs, like controllable costs, uncontrollable costs. We talked about direct costs, indirect costs, the allocation of indirect costs, the allocation of support departments, and all of the other things about responsibility accounting. We also talked about transfer pricing. Now, of course, we need to cover a couple of other ratios and formulas to help you understand how a manager evaluates the performance of the business. One of these is called the cash conversion cycle. This tells us how quickly we are converting the account receivable into cash, basically, in a pretty basic manner. So here are the components used to calculate the cash conversion cycle. You'll notice that there's three parts. You take days sales and accounts receivable plus days sales and inventory minus days and payable outstanding, or days and accounts payable outstanding. So there's three different formulas that equal this one formula. Days sales and accounts receivable, we take accounts receivable divided by the sales times 365 days. Days sales and inventory, we take inventory divided by cost of goods sold times 365 days. The days and accounts payable outstanding, we take accounts payable divided by cost of goods sold times 365 days. So we add days sales and accounts receivable plus days sales and inventory minus days and accounts payable outstanding. This gives us what we call the cash conversion cycle. So days sales and accounts receivable plus days sales and inventory minus days and accounts payable outstanding equals the cash conversion cycle. This example, 10 days. That's pretty good. Anything less than 30 is decent. Anything longer than 30, you start to run into problems. And this last concept is that we briefly talked about in a prior chapter is called joint costs and their allocation. I showed you what it looks like from the perspective of service departments and indirect costs from the Macy's jewelry department example. I also showed you in a previous chapter how joint costs work when it comes to one product sharing costs. Okay. Joint costs are costs that are incurred to produce or purchase two or more products at the same time. Here we have an example of a dairy company that incurs joint costs when it processes raw milk. It goes through the process, right? Process it further, process it further, process it further to get the different percentages, right, for the milk. We do the same thing with oil, right? Same process. Crude oil, process it further to gasoline, process it further to kerosene, process it further to other fuels. So how do we allocate the joint costs? In this example, we take the sales times the percentage of the total to find the allocated costs. Sales minus the allocated cost, getting down to the gross profit. So, interesting concept. So that is the end of our discussion on responsibility accounting and also the performance management. Are there any questions, comments, or concerns about responsibility accounting and performance management? Did okay? Great. Let me stop this part of the recording and then we'll jump into the next chapter and then we'll finish up for today. All right, cool. Please stand by.